You've heard of inflation, you've heard of deflation, but do you know about stagflation? Ray Dalio, right now, thinks we're in a period of stagflation. And if you don't know about it, I can tell you one thing. It is not a fun period to be in, and every investor needs to be prepared for it. So let's see what Dalio has to say on stagflation and a bunch more topics. Now, before we get into this, I just want to say a little thing or two about Ray Dalio. Ray Dalio, he's a good investor. He's a pretty good investor. That is how I would classify Dalio. But I would not call him one of the great investors. Why do I say this? Well, because over the past 28 years, Dalio has averaged a return of 11.5% per year, an average return. So he's really only just beat the market each year. He's not a top high performer compared to the likes of Warren Buffett. Warren Buffett achieved an annual average return of 20.1% from 1965 to 2021. And you might think, well, the difference is only around 8.5%, but that 8.5%, when you take into account compound interest, is a massive deal. So let's just do a quick calculation here. Let me quickly record the screen. So let's say you start with an initial investment of $50,000. You contribute $500 to that investment every month, and the time period is 20 years. The estimated interest rate, okay, we'll do Dalio first. What did he get? 11.5%, 11.5, variable change 0, compound frequency monthly. Okay, so let's see if you get 11.5% return every year, what this $50,000 compounds into. Press calculate, and it compounds into $955,000. However, now let's say you get a return of what Warren Buffett's average return was. Let's see how that changes. If you got a return like Warren Buffett, that $50,000 would turn into $4.6 million. So even though Buffett got an 8% return higher than Dalio, you might think, oh, that's not that much. When you take into account the magic, the eighth wonder of the world, compound interest, it's a big deal. Nevertheless, Dalio, he's a good investor and he's very consistent. He's known for achieving very low volatility each year. So that is his main goal, low volatility, ensure that his clients do not lose much money. And one thing that he's very good at too, better than Buffett at, is the macro side of things. So in this video, we're gonna be talking about Dalio's macro outlook in the USA market. What does he think?
I mean, these things happen over and over again. We're now in the 12th and a half cycle. You know, these cycles, you know how the cycles work. You're 12 and a half cycles since 1945. 1945 was the New World Order, you know, new monetary system. And you know what happens. So let me take you through it quickly. You get a funky economy, weakness, and so on. So what we had, of course, in 2020 with the combination of COVID, and then also the move from the right to the left. There was a distribution of wealth. And so how did you do that? The government had to send out a bunch of checks.
Yep.
And the Federal Reserve, where did the government get the money from? The Federal Reserve lent it. So we have an imbalance. And of course, that put a lot of money in the system. You've got the demand, you've got the cycle, classic cycle, right? Stimulation, credit becomes debt, then you have inflation, then you have a tightness of monetary policy. And so where are we? So we now in a classic spot where we've got a relatively high real interest rate. Real interest rates went from minus 175 basis points to plus 175 basis points, right? You've got a cash rate that's relatively high. Cash used to be trash. Now cash is relatively attractive.
So yeah, Dalio is saying that cash has now become attractive. Why does he say this? Well, he's saying cash is more attractive because interest rates are so much higher. Interest rates went from basically 0% to, what is it now, 4.5%. So if you keep your money in the bank, you're going to get a higher rate of return. However, inflation still is at 6%. So if you keep your money in the bank, are you actually going to make any money? Well, it depends. It really depends what's going to happen with inflation. If inflation stays at 6% and interest rates stay at 4.5%, well, you're actually not going to make any money. Well, I guess the assumption is that the rates will go up a bit, the interest rates will go up a bit, and inflation will go down a bit, and you'll actually make a real return. So, what does this mean when cash becomes more attractive? It just means that investors are more likely to put their money into cash, to play the safer option, as opposed to getting their money and saying, well, there's no point in having it in the bank, having it in cash. Let's put it in the stock market. Let's invest it in a business. So that's what you're seeing there. More money in the bank, more money in cash, less money out in the economy, less money out in the stock market.
You have the classic movement, of course, as rates go up and money becomes tight, you lose the parts of the economy, the parts of the market that are the bubble parts that needed the cash flow, right? So you see the tech stocks come down, all of that come down. You see private equity, you see venture capital because they needed cash, all of that comes down.
So that is a very interesting thing to note down, that when interest rates go from something very, very low to, well, they've gone from 0.25, 0.5% to 4.5%. What of that? They've almost quadrupled? No, what is that? They've almost gone up 8 times the amounts. Crazy amounts they've gone up. So what happens when these rates start to go up? Well, essentially it means it's harder to borrow money. If I want to borrow money, I have to pay a higher rate, interest rate, to the bank. So I'm less inclined to borrow money. There's less cash in the system as a whole. So what happens when the economy goes from having so much cash, everyone's got money, to less and less people have this excess cash? What is the group of stocks that gets hit the worst? It's those speculative ones, the riskier ones where people invested on a growth idea instead of on current assets, current cash in the bank, their current business model. They were investing on an idea that this stock will one day grow. These are the type of stocks and assets that get hit the worst when interest rates start to go up. So the likes of Tesla stock, people were assuming high growth rates on Tesla stock, and now those assumptions come down. Roku stock, FTX, GameStop, AMC, Dogecoin, Shiba Inu. You guys get the point. It's the riskier assets that come down when interest rates go from very, very low to something higher. And this is why it's so important to pay attention to the Federal Reserve and what they're doing with interest rates, because you're going to get a feel, in a way, for what assets you do want to be in and what assets you don't want to be in.
So you could see which sectors are going down. You could see which stocks are going down, right? You see the tech stocks, you see real estate going down. Residential real estate goes down, and we're having something close to let's say a stagflation, meaning maybe 3.5. I think you're going to see inflation come down to this, and then because of the way it's calculated, it'll go up a bit. And so you see that kind of an environment with something close to maybe a 1% growth rate. Right. Something like that, right?
He didn't actually say in the clip that we're going to be having stagflation for 1 year, another 2 years, another 3 years. He didn't make an expectation on stagflation. All he said is that right now we currently are in a stagflation type period. So what is stagflation? Stagflation is when you have high inflation. So this is not a good thing. No one likes high inflation. But then on the other hand, you also have a slow economic growth. So you're kind of getting hit with this double whammy of high inflation, but your economy and your stocks and your businesses are not growing as much. Their earnings aren't growing as much. Stagflation is not a nice period to be in. It says stagflation has occurred twice in the US, once between 1974 and 1975, and again between 1978 and 1982. All of this happened during a period known as the Great Inflation. When stagflation is present, workers make less money, but they have to pay more for the things they buy. Investors see lower returns due to slow growth, and the longer stagflation continues, the more it impacts the future value of their investments. So during these times, just from a personal level to you and me, there's a couple of things that we want to be sure of. One thing is you do want like a little bit of cash on the sideline just in case things go crazy and you need that cash. But do you want to have a ton of cash just sitting in the bank when inflation is so high and growth so low? Also, maybe not. Ideally, well, first of all, from a job perspective, you want a job that is safe and secure and where your wages will keep rising with inflation. And it's the same with the stocks or the businesses that you buy. You want a business that can raise their prices as inflation gets higher and higher. Perfect example would be Coca-Cola. When inflation increases, Coca-Cola shareholders don't mind too much. It's okay, we'll just raise our prices along with inflation. So those are the types of businesses you want to be in if stagflation lasts a while. Another thing, you don't want too much debt. With high interest rates, debt is not a fun place to be. Speaking of debt, the USA isn't in the best situation when it comes to their debt situation.
But what's also happening in that cycle, since 1945, is that we then have the accumulation of a lot of debt and money. Okay, so we deal with things like the debt ceiling. Does the debt ceiling matter? Does it matter how much debt we have? And then you have a situation where there's used to be a free market supply-demand, but now you've got the Federal Reserve who is now taking it, buying it on the balance sheet, so it's not the supply-demand. So you've got that dynamic very classically going. I don't think people are paying enough attention to the big cycle. There are these short-term cycles. Since World War II, they've averaged about 6 or 7 years, plus or minus about 3 years. That's what we're in a classic one of those. But we keep building up the debt.
If you take a look at the USA's current debt, it's just surpassed $31 trillion, and that has increased a lot since the pandemic, where they had to print a lot of money and get into more debt in order to service all of the economic troubles that came with the pandemic. Now, okay, it's all fine and dandy when the interest rates are only 0.5%, because when interest rates are so low, your interest payments on that debt is nothing. Okay, we can easily afford to pay 0.5% interest rates. What happens when the interest rates increase by 8 times the amount? What happens to your regular payments that you have to pay out? The question is, can the USA afford this? Especially if interest rates keep going up and up and up above 4.5%, which, let's see what happens there.
The biggest issue is that there's more spending, and I would say there probably needs to be more spending than we have income. And that's a problem, right? Governments run the same as your household or a business in that, with 2 exceptions. They can print money and they can tax, right? So then when you spend more than you earn, the question is, and they're going to spend more than they're going to earn, where are you going to get the money from? Are you going to get it from taxes? And if you get it from taxes, people fight because they don't want to give up their money. Or are you going to get it from printing the money? And so how do you achieve that balance? Because do you spend less? Right. Well, it's a tough environment to spend less. You have to spend more on defense. You have to spend more on rebuilding. The Green Initiative is expensive. I mean, education is expensive and so on. So there's a dilemma that she is sitting in, that we as a country are sitting in. So, how do you solve that problem? I think that, if you were to, let's say, take the bigger picture, there's a lot of things that you can invest in that will produce returns. And I think, for example, I don't think we invest nearly as much in the basic things like great education and making sure that certain areas do not have conditions that are substandard conditions. And so to invest in those things that are going to produce productivity. Education's a good thing. Infrastructure's a good thing. Other things. But this is part of a cycle, a big cycle that has happened over and over and over again.
So this is very interesting. Look at this graph here. This is the USA's budget deficit or surplus. As you can see, over the past 80 whatever years, the USA has pretty much run a deficit. And look at the debt since 2008. The debt has just gone up and up and up. So the question is, when you keep running a deficit, is, well, at some point you need to pay that deficit back. You need to actually get the money. So how do we get this? One way we can do this is we can spend less money. We could spend less on Social Security, less on military and defense, less on health, Medicare, Medicaid, transportation, all of that. But who is gonna want to do that? Imagine a politician says, guys, I'm going to come in, and when I get to power, what I'm going to do is I'm going to spend less. Your Social Security is going to be less. Military and defense, we're going to decrease. Your health care for Medicare and Medicaid, we're going to lower that. Who's going to vote for that politician? No one. So they're not going to spend less. Let's just be honest. Now, the other thing that you can do is tax more to get more of an income. Imagine another politician comes in and says, guys, when I get to power, this is what I'm going to do. I'm going to tax you more. Everyone, you. We're going to charge a higher tax rate. Well, who's going to vote for that guy? No one. So are they going to tax more? Probably not. What they're probably going to do is they're going to keep printing more money over the long run. The only problem with this is the more you print money, the higher inflation is, because the more money you put into a system, the less each of those dollar coins are worth. The other thing that you can do is just grow the economy to pay off this deficit. And this is kind of what Dalio wants to see. He's saying invest in education and the likes of this, so that we'll have smarter citizens who can build better businesses and make more money and pay off the deficit that way. In an ideal world, that would be the best way to pay off the deficit. Let's see if that happens. And in a way, this is kind of what I'm trying to do with this channel, is teach more about business and maybe focus a little bit less on the politics side of things, because I think the more we know about business, I think this is a good thing for the world. Call me crazy. But now let's move on to the stock market.
Where do you think the stock market is? Do you think that we have priced in what could be a recession, or what is a recession? Did we see the worst of it in October? Where are we right now in terms of valuation?
I think the markets as a whole they were obviously, I would say, the interest rate changes were obviously had to come. The impact on the other markets had to come. They have come. They have been into the price. So now you're going to have probably a tightening or a tighter monetary policy than existed. And that's a net negative for the stock market, but not in such a big number that it's like a big bearish thing. So when I look at the market as a whole, I would say, okay, well, now it seems closer to fairly priced, probably still a bit high, given that whole picture.
As I say, when it comes to the stock market and the future of the stock market, especially the short-term future, it can be a very hard thing to predict. But Dalio thinks maybe fairly valued, maybe a little bit high right now, because the Federal Reserve is tightening their monetary policy. So that's a little bit of macro news from what some people call the macro GOAT. I guess some people think Dalio's the best when it comes to the macro side of the economy and the macro side of all businesses. Warren Buffett is, of course, the king when it comes to the micro, analyzing business by business. And I think it is a lot smarter to just do things in just the micro. You actually don't really need to pay that much attention to the macro. If you can just keep buying good quality businesses, it doesn't matter too much what happens to the economy. Those good quality businesses will get you through. They will keep making money, keep generating cash flow, keep generating returns for you as an investor. So the most important thing really is to focus on what you're doing and the micro investments that you're making sure you're buying those good quality businesses for attractive prices, or index funds or dividend stocks, whatever your strategy may be. That is the most important when it comes to the stock market side of things. But I always like seeing what people are saying on the macro side of things too.